Hello, and thank you for taking a moment out of your busy schedule and to hear this information that has been a quiet kept secret amongst the very rich and the wealthy, the one percenters and the three percenters of the world since the 1800s. This information changed my life. And so when this information changed my life, I took it upon myself to spread the word because every individual needs to know and understand how money works. With that said, here we go. Thank you once again for coming to this financial planning strategy, understanding how we build generational wealth. I am Orlando C. Farrell. I am a financial strategist and a retirement planning specialist. I help my clients optimize assets and minimize their taxes and empower their true wealth, true authentic wealth, wealth that you cannot outlive, wealth that's going to be around for generations to come. I am licensed to do business in Texas, Louisiana, Arkansas, New Mexico, North Carolina, California, and also in the process of getting licenses in Nevada. Our mission is to empower people through financial education and entrepreneur mentorship. Our business model and financial platform can help every person achieve his or her financial goals. So our main mission is to one, so we have in our mission, we have four things that we want to do. And the first thing we're going to do in our mission is to want to keep your money. Keep your money in a zero tax bracket. IRC 7702, Internal Revenue Code 7702. We'll talk more about this later. And then what we have, we're going to guarantee that we're going to grow your money without ever having to risk your money. We do that by using index strategies to where you are guaranteed to never lose a dime of your contribution and able to get all the growth. And then number three, we're going to guarantee you a lifetime income. A lifetime income that will outlive you, that will be passed down to generations to come. And then lastly, four is to protect your money. And we protect your money through what we call living benefits in the event that you become sick and you happen to die. Well, we're going to protect your money. We're going to show you how. So here are just some vital statistics. And according to American Heart Association, every 40 seconds, a heart attack or a stroke occurs in America. According to the American Cancer Institute, 1 out of 2 men and 1 out of 3 women will develop cancer in their lifetime. According to the National Highway Traffic and Safety Association, on average, there are 6 million car accidents in the United States every year. That's roughly 16,438 car accidents per day. Now, according to the Center of Disease and Health Control, the number of deaths from all causes is 2,886,000 854,838 in the United States every year. That's roughly 7,821 deaths per day. If you or your family become part of this statistics, is your financial house and estate in order? Can you guarantee your loved ones that all your hard-earned assets are protected and preserved? If not, let us help you save your family's financial future today. Now, estate planning. This is one of the services that we offer, estate planning through Infinite Docs. What does estate planning consist of? Estate planning consists of wills, power of attorney, healthcare directives. Now, you want to build and leave a legacy? Well, it is a proper way to do that. There is a proper way to build a financial house. And in building any home, would you agree that it needs a strong foundation first? I mean, to say you can't put up walls and then a ceiling and a roof without a foundation. It will all crumble and fall. Well, this is the same principle that applies to when it comes to leaving a legacy or building a legacy for your families and loved ones. First step, the strong foundation, is estate planning. Everything that I just said earlier. Wills, power of attorney, healthcare directives. That's step number one. Step number two is protection. Then, excuse me, then after protection, you have debt management. Manage your debt. And then once you manage your debt, you want to be able to have an emergency fund set aside, at least 10 times your income. And then when you have your emergency fund set aside, then you get you some investments. Then that's when you're able to leave a legacy. Now, there's two types of protection. You have temporary and you have permanent. Temporary is term insurance. This is insurance that you can get from your employer or personal. The premiums are leveled or increasing. The death benefit is fixed. The cash value, there is none. The interest rate, there is none. Then you have permanent. Well, there's 4 types of permanent insurance. You have whole life, then you have variable life, then you have universal life, and then you have index universal life. Now, for the whole life, the premiums are for a lifetime, meaning that you're going to pay for it until you die. The death benefit is fixed. The cash value is a fixed rate, and the interest rate is 1 to 2%. Now, whole life and term life is not for the living. It is for the beneficiary after you die. Death insurance, okay? Then you have variable life. Variable life, the premiums are flexible, the death benefit is risky and is variable, the cash value is risky and variable, and the interest rate is market driven, and it means that it is risky. Anytime that you have a variable product, variable products consist of 401ks, 403bs for hospital workers and educators, 457 plans for police officers and firefighters. You have 529 college growth saving plans. You have traditional IRAs. You have the Roth IRA. You have thrift savings plans for federal employee workers. All these are variable accounts. Variable meaning that you have a 50-50 chance to lose your contributions, okay? The money that you work so hard for. And then you have universal life. Well, universal life, it is better than the variable life and whole life and also the term life. However, with the universal life, the premiums are flexible, the death benefit is very flexible, and the cash value is a guaranteed minimum. And the interest rate is anywhere from 3 to 5%. Then you have index universal life, which is my favorite one. Why? Because the premiums are flexible, the death benefit is very flexible, and this is the reason why I say this is my favorite one, is because the cash value is indexed. Index meaning that your money will never be at risk in the market. Index meaning that you will only get the upside of the market and never have to worry about the downside, because with an index account, it's not tied directly into the stock market. And then on top of that, it gives you an interest rate of anywhere from 6 to 10 to 22 to even some years 64% interest annually, and you never pay any taxes on the growth of the money. So these are the type of protections that's out there, okay? Now here's what we call the X-curve concept. And the X-curve concept says this. Over here on the left side, you see a lady, a gentleman, and they're both holding up their family, their home, and also their vehicle, their life. Now, in the event one of them happens not to be around or get sick or have an untimely death, if they don't have the proper protection in play, they won't be able to withstand and hold everything in place like it is now, because the other income is no longer available. So what we do is we do a dime. Dime is when you want to be able to make sure that in the event of any sickness or untimely death, you want to make sure that you have enough protection that's going to eliminate your debt. You want to make sure that you have anywhere from 10 to 20 to 30% or 30 times your income, annual income. And then you want to make sure that your mortgage will be paid completely off. And then you want to make sure you have enough money there also for the kids' education, because don't you want your kids to go further in life and do better? So in the event that neither one of the people are there, well, with the dime method, you're going to have all that taken care of, meaning that your family won't have to sell the house or the car, the kids still be able to go to school, whatnot. So you start off on the left side when you're young, and when you're older, you want to make sure that you're over here in the financial freedom. Houses paid off, cars paid off, kids going to college and all of that, right? So this is what we call a wealth formula. And the wealth formula says this: you need money plus time, and you want to have it in a vehicle that the rate of return doubles every 6 to 7 years, and it outpaces inflation, and you never have to pay any taxes on the growth of the money. That equals wealth. That is the wealth formula. Time plus money, or money plus time, plus rate of return minus inflation minus taxes. So this is what it looks like for an individual who needs to want to be able to retire with $1 million. You know, this here chart shows you how much you need to save each month to retire. So if a person has, and this here is assuming rates and annual compound interest return on investment, okay? Now, on the far left side is how many years that you need to continue to working before you to retire. So if a person needs 40 years to retire and they putting away $190 in a 10% interest earning account, well, they need to do that for 40 years, put away $190 in a 10% interest bearing account. That'll get them $1 million. In an 8% interest bearing account, $325. In a 6% account, $540. And then in a 4% interest bearing account, you need to be putting away $880 a month. Then if you got 25 years to retire, well, you need to be putting away $850 every month in a 10% interest bearing account to be able to retire with $1 million. In an 8%, you need to put away $1,150. In a 6%, you need to put away $1,520. And in 4%, $2,010. Now, if you only need 10 years before you retire, you need to be putting away $5,300 a month in a 10% interest bearing account to be able to receive $1 million in retirement. In an 8%, you need to be putting away $5,800. In a 6%, you need to be putting away $6,350 a month. And then in a 4% interest bearing account, $6,950 and an interest in a 4% interest bearing account. Many Americans are not able to put away that type of money in that time frame at a 4% interest. But see, this is where most people have their money at, right? In the 4%. We're going to show you how to have your money over here in the 10%. Okay. Now, this here is the rule of 72. Now, the rule of 72 was considered one of the 8th wonders of the world by Albert Einstein because of the compounding of the interest that it does. And here's an example of what compounding and interest look like. So the rule of 72 says this: you would take the interest rate your institution is giving you from having your money parked there or set there, and you would divide it by 72, and the number that you come up with is how many years it's going to take for your money to double. So most traditional banks and credit unions, they're only giving you 0.001% interest annually. So when you divide that by 72, the answer is 72, meaning that it's going to take 72 years for your money to double in a traditional bank or a credit union, CD, stocks, mutual funds. Now, here's an example of the rule of 72. And in this example, there's 4 different interest rates. You have a 4%, 6%, 8%, 12%. In a 4% interest bearing account, when you divide that by 72, the answer is 18 years, meaning that your money doubles every 18 years. So you take a 29-year-old person who puts away $10,000. Well, 18 years later, that $10,000 now doubles to $20,000. 18 more years later, it doubles to $40,000 at age 65 in a 4% interest-bearing account. In a 6% interest-bearing account, when you divide that by 72, well, your money now doubles every 12 years. You take that same $10,000 at age 29, and money doubles every 12 years at age 41. At age 53, $40,000. At age 65, $80,000. Then you take that same $10,000 in an 8% interest-bearing account, your money doubles every 9 years. Same $10,000 at age 29, 9 years later, at 38, the money doubles to $20,000. 9 more years later, at 47, the money doubles to $40,000. 9 years later, at 56, $80,000. 9 years later, at 65, $160,000. Now, here is what an example look like in a 12% interest-bearing account. Your money doubles every 6 years. Put that same $10,000 in at 29, 6 years later, 35, your money doubles to 20,000. 6 more years later, at age 41, 40,000. 6 more years later, 47, 80,000. 6 more years later, at 53, 160,000. 6 more years later, at age 59, 320,000. At age 65, your money has now doubled to 640,000. So the difference between 10,000 at a 4% versus a 12% is $600,000. Now, 600 is equal to 20 years salary of someone who's earning $30,000 annually. Where would you prefer to have your money at? Right here, the 12%, right? So when it comes to managing your money, which one would you prefer to have? Growth or safety? Or tax advantage or protection? Well, what if I told you and showed you that you can have all 4 of these: growth, safety, tax advantage, and protection, which is the 4 building blocks of obtaining and gaining true, authentic wealth, wealth that you cannot outlive, wealth that will be passed down through generations to generations to come. Now, this is how money gets taxed. As you can see, you have the tax now bucket, the tax later bucket, and also the tax advantage. Now, in the tax now bucket, that consists of bank accounts, bank CDs, stocks, mutual funds. These are assets that are generally held outside of retirement plans, and they are taxed at capital gain tax rates. Then you have tax later, which consists of 401ks, 403bs, IRAs, SEP IRAs, annuity plans, and pension plans. Now, these are assets held in retirement plans, and they are generally taxed at an income tax rate. And then you have tax advantage. Tax advantage, that bucket consists of Roth IRAs, municipal bonds, 529s, plans, 7702 plan. Remember that 7702 earlier? Well, these are assets that are often overlooked, and the distributions are tax-free. Now, this here is your own power to choose. This here is a financial report card and or a scorecard. So each one gives you a score. So in financial portfolios, a checking and saving accounts and the CDs, well, it don't give you any growth. It don't give you any, it does give you safety. It don't give you any tax advantage, and it don't give you any protection. So it gives you a score of 1. And then you have stocks, mutual funds, 401ks, 403bs, variable IRAs, and pensions. Well, they give you growth, but they don't give you any safety, nor do they give you any tax advantage, nor do they give you any protection. What do I mean about safety? They don't give you any safety against the stock market, because these are generally tied or are tied directly into the stock market. So your money is at risk. Then as far as protection, it don't give you any protection, nor does it give you any tax advantage. Then you have the Roth IRA. The Roth IRA, it does give you growth. It don't give you any safety. It do give you tax advantage, but it don't give you any protection. So it gives you a score of 2. Then you have 529 savings account, and then health savings accounts also. They don't give you any growth. They don't give you any safety. They do give you tax advantage, but they don't give you any protection. So it only gives you a score of 1. Then you have LTC, long-term care or municipal bonds. They don't give you any growth. They do give you safety. They do give you tax advantage, but they don't give you any protection. So it gives you a score of 2. And then you have the IUL. Well, the IUL, it gives you growth, safety, tax advantage, and protection. It gives you 4, a score of 4. And though that score of 4 are the building blocks to obtaining and gaining authentic true wealth, growth, safety, tax advantage, and protection. Now, here is the options for your money chart. And there are various ways to invest your money. Here in broad terms are the 3 options. You have fixed, variable, and indexed. Now, inside of each one of these charts, the lines that represent your money or is your money. So just off of visualization, knowing that each one of these lines in each one of these charts represents your money, just off of visualization, where would you prefer to have your money growing for you? The index, right? Absolutely. It's a no-brainer. So now I'm going to explain to you the difference between the 3, and you're going to understand why the index is the best. So with a fixed account, that line, your money, as you can see, it's not doing anything. It's not growing. It's not decreasing. It's just there. It's flatline. I call it graveyard money or sleeping money or dead presidents. It ain't working for you. It's just there. And as we said earlier, when you have your money in a fixed account, which consists of traditional banks, credit unions, CDs, stocks, and mutual funds, well, it takes 72 years for your money to double according to the wealth formula. How many 72 years are we guaranteed or promised in a lifetime? Not even 1. So it don't make sense to have your money sitting somewhere to where it takes 72 years for it to double. But if one don't know any better, how are they supposed to do any better? And this is the reason why I'm making this video, to educate you so that you can be educated about how money works, and then you can make a better decision on where you really and truly want your money to grow. Then you have the variable account. The variable account, it looks just like the stock market. Your money's going up, down, up, down, up, down, up, down, up, down, up, down. This is the stock market. What accounts do these consist of? 401ks, 403bs for hospital workers and educators. You have 457 plans for police officers and firefighters. You have 529 college grow-up saving plans. You have traditional IRAs and Roth IRAs. You have thrift savings plans for federal employee workers. All these accounts are variable, meaning that you have a 50-50 chance or a 50-50 opportunity to lose the money that you work so hard for. And with the variable account, what a person don't know is you have went into a contractual agreement or a partnership with the government saying this: I agree not to pay you any taxes on my seed money, my employer contributions, but I do agree to pay you taxes on my nest egg or my harvest in retirement when I need my money the most, on some future unforeseen date, knowing that the taxes could be double or triple than what they are today. Now, when you think about that just don't make sense, right? But once again, if one don't know any better, how do they supposed to do any better? Now, with the variable accounts, you can't even access your money until you are the required retirement age of 59 and a half. If you try to access your money before the required retirement age of 59 and a half, you will be penalized 10% and you will have to pay taxes at the current tax rate. And when you lose money in a variable account, well, it takes twice as long for it to break even. So let's say your account loses 50%. Now your account has to gain 100% just to break even with the 50% that it just lost. Twice as long. Then you have the index account. The index account, my favorite vehicle. This here index account has been around since the 1800s. And this is how the rich and the wealthy has been growing their money for centuries. There's two main reasons why you never lose any money in an index account. The first reason is it is not tied directly into the stock market, unlike the variable accounts are. It shadows the stock market. So therefore, you are allowed to get all the gains and the interest from the market without ever have to worry about incurring any losses because it's not tied directly or plugged directly into the market. Two, it has what you call a floor and then a ceiling, meaning that when the market go up, our money is going to go up with the market, but when the market go down, our money don't go down, it locks and becomes a floor. And the floor can be anywhere from a 10 to a 6 to a 3, nothing below 0. 0 is your hero when you have an index account because you are guaranteed to never lose a dime. So now your floor is now here. Your floor started off here. The market went up, it came here. The market went back down. Your floor is now at 6%. The market go back down, your money don't go back down. It stays right here at the 6%. When the market get ready to go back up, guess what? Our money goes back up some more with the market. The market get ready to go back down, guess what? Our money don't go down, it locks. It becomes a floor. So we never lose any money in an index account. And the index account gives you an interest rate annually of 10 to 22 to 64% interest annually, and you never have to pay any taxes on the growth of that money. And you don't have to be 59 and a half to access your money. You can access your money whenever you want to access your money, tax-free. So, what is an index account? An index account is what we call a flex life index universal life insurance. That's right, insurance, but the right type of insurance. So the flex life index universal life, it is a financial solution in case you die too soon. You're going to have a lifetime protection. Protecting who and what you love is a top priority. And then if you live too long, it has a potential for a tax-free income for life, guaranteed. So you can make the most of your retirement. And then if you become ill, it comes with living benefits, helping you and your budget survive a qualifying illness or injury. This gives you those 4 building blocks to obtaining and gaining true, authentic wealth. It gives you growth. It gives you safety. It gives you tax advantage, and it gives you protection. So what are living benefits? Living benefits consist of this. These are qualifying events. In the event that you are developed or diagnosed with terminal illness, Generally, if you have been diagnosed with a terminal illness that will result in death within 24 months to 12 months, in some states, a certification of the illness by a physician, it activates and pays you a tax-free lump sum. So I'm going to use myself for an example because I have two of these accounts. If I develop terminal illness and they tell me, Orlando, you're going to die within 12 to 24 months, my living benefits on my IULs, Index Universal Life Policies, will activate and pay me $1.2 million lump sum tax-free because I have been diagnosed with terminal illness and I'm going to die in 12 to 24 months. I don't die in 12 to 24 months. I don't have to pay that money back because it's my money. Chronic illness. Chronic illness means a doctor has certified within the past 12 months that you are unable to perform 2 out of 6 activities of daily living for a period of at least 90 consecutive days without assistance, or that you are generally cognitively impaired. Activities of daily living consist of this: bathing, constituting, dressing, eating, toiletry, transferring. If I'm not able to perform any of these, 2 of these daily living activities for a consecutive 90 days without assistance, my IULs activate and pays me a monthly income of $35,000 a year. $35,000 a month to hire somebody to come in and take care of me until I'm able to take care of myself again. So now my family don't have to be worried about missing work to take care of me because now, no, I have this right protection in place and I can hire somebody to come in and take care of me in the event that need to happen. Critical illness consists of or includes ALS, Lou Gehrig's disease, arteriographic surgery, aplastic anemia, blindness, cancer, cystic fibrosis, end-stage renal failure, heart attack, heart valve replacement, major organ transplant, motor neuron disease, stroke, sudden cardiac arrest. My IULs, I have 2 of them that will kick in and they will pay me $875,000 tax-free lump sum. Critical illness includes if I have a wreck or I'm in an accident and I become in a coma or I become paralyzed or I'm severely burned in a house or a car catches on fire or traumatic brain injury. It also activates and pays me $875,000 tax-free lump sum. Now, even though it does all that, the living benefits could be used for, but not limited to, household expenses, home modification, nursing home care, adult daycare, regular bills, quality of life expenses, and also lifelong dream vacation. That's right. I can use that money to do all of that as well. So let's get started. When we build you a personalized program, it's going to be based solely on your needs now and in the future. We provide you with liquid assets that are safe and earn you returns as your money grows. You're going to have easy access to your funds, meaning that your funds will always be liquid. You will always have liquidity to your money. Unlimited tax-free potential, meaning that you can grow $1 million and don't even ever have to pay any taxes on the $1 million. Our plan also protects you and your family from unknown disasters. Our saving strategies provide you with only upside potential without no downside risk. So Take action. Get started today. Get back with the person or talk to the person who invited you to this financial planning event. Request for our complimentary and non-obligatory comprehensive 2 hours minimum of financial planning session. The usual cost is $2,500 an hour. There is no required 1 million minimum assets to book a session. There is no retention fees, charges of 25 to 100,000 a year. Find out how to become a member of our infinite company, OIC, and have access to a lifetime of financial coaching, membership benefits, and privileges. A wealth of financial knowledge, tools, resources, and a lot more, and experience true financial freedom for you and your family. A generational wealth legacy worth passing on for generations. I am Orlando Farrell, and I want to thank you for taking the time out of your day to view this presentation. Thank you. God bless. Well, ladies and gentlemen, I hope you really and truly enjoyed that financial presentation about how money truly works. Now you understand. Now it's up to you to make a sound, educated decision about where you want to have your money at. Do you want to continue to have your money in variable accounts and you losing your money every day? Or do you prefer to have your money in an index account to where you never lose? You never worry about if the market is going to go down. We don't care if the market go down, because when the market go down, when everybody else is losing their shirts and pants, guess what? Anybody who has an index account, we're not losing anything. We're just sitting there waiting till the market come back up. As soon as the market go back up, our money's going back up with the market. So once again, thank you. And I hope this information has been life-changing information. And as I always say, the only difference between a wealthy person and a poor person is information, and information that is applied. The only difference. God bless. Hope to see you soon.